What is going on, Wealth Our Way Nation? It is your main man, Charles Tank Harris, the founder and chief visionary officer of the financial literacy platform, Wealth Our Way, where our motto is wealth is not only for the wealthy. I want to welcome each and every one of you to episode 23 of the Financial Power Hour. The year is just chugging right along. We got a great show lined up for you tonight on what you need to know about crypto. But before we get started, I want to practice the attitude of gratitude and thank each and every one of you who are here with me live as I stream across the Wealth Our Way Facebook page and the Wealth Our Way Network YouTube page. I want to give the salute to Wild Nation members who will watch this program pre-recorded overnight, over the weekend, wherever they can squeeze their financial literacy fix in. And then a heartfelt how are you to the good folks on the Life 101 platform who listen to the audio recording of this very here program. And with that, we kick off tonight's show.
I grew up in West Philly, and times was tough. Single mom, 4 kids, there was never enough. What's a youngin' to do? Join a gang or a crew, or go to school, hit the books, and find a mentor or two. God was on my side, Mom's was not with the games, so I studied extra hard, created a lane, read books by Warren Buffett and Benjamin Graham, spent time on Wall Street, and now I'm the man. But there's still much to do, and plenty to say, so I present the Power Hour, by Wealth Our Way. Enjoy the show.
What is going on tonight, everyone? You know, normally, everyone who knows about the show knows I don't do a script. I just come off the hip all the time with what flows through this mind of mine. One of the things that I want to do tonight, before I even get into the show, is thank the Wealth Our Way team that makes this show happen. I want to give a special shout out to Renee Baskerville for just always being the glue that holds the show together. And of course, the main man in the cloud up above, Zach, just keeps us focused, just keeps things rolling. He's brought a level of professionalism and editing style and grace to the show that without, we would still be in the caveman days. So I thank both of you guys for keeping the Financial Power Hour, making it tight. Thank you, thank you, thank you. So let's talk about tonight's show. This is a kind of off script show as far as when we were going to actually have it, because it was going to be probably a month or two down the road when we talked about cryptocurrency again. We talked about it at the top of the year, but with all of the volatility that has surrounded cryptocurrency, we decided to do a show sooner than later. And I don't talk about cryptocurrency without having two of the brightest cryptocurrency minds, not only that I know, but in the industry as a whole. So we're going to start off tonight talking about my main man, Chad Copeland. So Chad is a friend. He's a friend of the program, but he's a friend of mine personally. He's also a business associate. He's, you know, I always like to tell people I don't have bosses, that I work for myself. But the truth of the matter is when you're an entrepreneur, all of your clients are your bosses. My staff are my bosses. Everybody's my boss. Chad is one of my bosses because, you know, I work closely with Chad and his brother at Cascade Advisory. I serve as the chief financial officer for Cascade Advisory. I vet all of the deals, the private equity deals that come through. Chad is the person who makes that company tick. And without his expertise and his guidance and keeping me in my box when I belong there, we would be all over the place. Chad is a certified expert when it comes to the cryptocurrency space. He teaches on Emil's higher learning platform. And with no further ado, I'd like to welcome my main man, Chad Copeland, to the show.
Much appreciated. Thank you, Tank, as always. I love the show. I feel honored that I'm on episode 23, you know, Jordan number or LeBron number, depending on when you grew up. So, again, humbled that you asked for me to be on here. And looking forward to a great show and you know, glad to participate. And I'm gonna let y'all know, Tank's being humble. Tank really keeps the company lights on because he's doing the big deals. So.
Well, I appreciate that, bruh. And the next cat to bring on the show, you know, it's funny. I'm just getting used to this hosting thing halfway through my first year of doing it, and I always try to make sure that in this day and age of being politically correct, being socially correct, you don't say the wrong things. However, I always like to reserve the right to put my foot in my mouth because I'm a wild and crazy dude. And I love Chad with every part of my being. But I got to put a but after that but I've known Devlin for decades. This guy is like, he's like a brother to me. Just Devlin mechanically. I met Devlin over 2.5 decades ago now, about 2.5 decades ago now, when he was a young whippersnapper coming to solicit one of my professional athlete clients to invest in a technology that was so far ahead of its time. He was basically putting an in-car entertainment system called ICE into cars. And now every day you're driving with Apple CarPlay and other interfaces in your car that my guy came to me. I'm here to tell you, hand to God, this was the first time I saw the concept was from Devlin McConaughey. And his tech background is ridiculous. And so it made perfect sense that when cryptocurrency, which is a combination of both technology and financial services, financial products, came to the mainstream, that Devlin would indoctrinate himself to it and learn everything that he could learn and become, once again, an expert in this field and in this space. He'll humbly tell you that he's not an expert. So will Chad. But when I tell you there's not two guys who I trust more to disseminate information to my audience than these two, I also welcome my brother Devlin McConaughey to the program tonight.
Thank you, my friend. Pleasure to be here. So proud of you and the team. Everything looks so polished, so professional, and just proud and honored to be on with Chad.
Thank you. We love you. We love you guys. And we try to show off. We try to make it look sexy because I'm not gonna bring Chad and Devlin to the house and it look messed up. So my team, we showing off tonight. We went out there and
nice.
we got it all popping for you. So let's just get into the nitty gritty. The audience wants to know, the Wild family. We talk on 15 Minutes of Finance twice a week about all things money. And one of the things that I have been really standing firm on is that the asset class of cryptocurrency is here to stay. In some way, shape, or form, it's here to stay. You still have central banks, governments around the globe, finding ways to participate in the space. You still have talks of regulation from every regulatory body that exists in America and beyond. Yet, there's such a mystery that shrouds the whole cryptocurrency space. And when you have mystery along with volatility, so uncertainty and volatility, everybody starts to question what the hell is going on. Maybe we were wrong. Maybe we shouldn't be in this space. Maybe this is tulip mania. Maybe we're gambling. And I want to make sure that my audience is always one of the most educated bodies out there. So I bring you guys on to answer questions. My audience is very interactive, but to also just spit the facts as you know it, because I know if nothing else, you'll keep a level of transparency. Say what you know, say what you don't know. So I'm going to start with a question. And the question is it still cryptocurrency time? I'm gonna let Devlin take it first, since I introduced Chad first.
If you, I think this is from a movie, but if you loved it at 65, you got to be married to it at 25, right? So nothing has changed. At the end of the day, nothing about the premise over the last 6 months of negative downtrend has changed. If anything, you're buying it on sale now. So if you look at it from that perspective, then absolutely, right? I think what you're experiencing now, though, is a coming together of and wiping away of some of the meme stocks. Meme cryptos, startup projects. You're getting a consolidation where if you're focused on major projects with real solutions, real integrations, solving real world problems, I think it's the right time. If you're chasing flyers and trying to get 100x return on the next, blip, probably not the right time.
I love it. Chad, you want to chime in on that?
Yeah, I think it's what Devlin said. If you loved it at 65, you'll love it, down at like 23, 22 right now. Furthermore, I would say it really depends on your investor profile, right? So for me, I'm a crypto investor. I'm not a crypto trader. I used to be a crypto trader. As an investor, I do think this is a great time, but I also think any time's great for the most part. As a trader, you still have to wait for a lot of things to shake out. You know, the macro environment, there's a lot of uncertainty that you have to be considering, especially for a risk on asset class. But going back to the investor lens, right? When crypto is down, not only is it potentially a good time to get in at a good price, but it's really a great time to get ingratiated into, get more ingratiated into actually tapping into the community and the ecosystem, whether that's conferences, reaching out to people on Twitter or YouTube. If this space has piqued the interest in you, just because the price is down, I don't think you shy away from it. I think you actually can take this as an opportunity to embrace it and actually learn more about the space while the price isn't, really volatile, really moving in one direction or the other too fast right now.
I love those answers. And what I tell people, you touched on it, Chad, about treating an investment sector the way you would treat any other investment sector. I believe most people get themselves in trouble. And it's funny because I have to manage people's enthusiasms for a living. People get themselves in trouble when they let their emotions guide them instead of plans and predetermined ideologies guide them. So I'm actually doing a private investment, a private equity investment with some of the Wealth Our Way clients and some people who aren't Wealth Our Way clients. And what I have is a bunch of people who believe that this private equity investment is a home run. They believe it. They're ready to open their checkbooks up. I have put a limit in place as to how much people can invest in it, partly because it doesn't matter how much money you have. You should always have a backstop and a limit. And partly because I am people's financial planner, so I know how much money they have. So people are getting different limits based on how much money they have. I've told some people you can do this much, some people you can do this much. And I invariably get the question, Tank, if you think it's going to work, why would you limit it? Why would you not go all in? And I let the answer be the question, because I think it's going to work. I don't know it's going to work. All evidence is telling me this should work. Everything that I know, every bit of logic, every bit of research, this should work. But guess what? It could still not. Or it could work a lot slower than we think. So we have to invest in everything that we do prudently. We have to invest with a plan. We have to have an ideology and a mindset for when things go well and when they don't go well. And people don't do that normally. Investing is an emotional hobby for a lot of people. When they think it's going to be good, they want to take home equity lines off their house and buy the sector, buy the cryptocurrency, buy the commodity. And you never do that. That's just not intelligent. Conversely, when things are going bad, people want to sell everything. That's not intelligent. So I'm going to, as I always like to do, it's a level of transparency. I'm going to talk about my own personal cryptocurrency situation. On January 6th of this year, I started dollar cost averaging $1,000 every Wednesday into 4 cryptocurrency coins. And what I would do is I would keep my Wednesday DCA schedule, and then I would also have an average down session, because we know now in hindsight, the first quarter of 2022 was very, very volatile. So I kept finding situations where outside of just dollar cost averaging, and let me stop there. Although I know a lot of you are regular attendees to the Financial Power Hour and 15 Minutes of Finance, I don't want to be guilty of what I find other financial people to be guilty of all the time, which is using acronyms that you may not know what I'm talking about. So DCA is dollar cost averaging. It means that I committed a set amount of money to invest into a set investment, in this case, cryptocurrency coins, at a set time interval, in this case, every Wednesday. And I committed to it regardless of what was happening in the space. If the space was down 50%, I still put $1,000 in. If the space was up 80%, I still put $1,000 in. That is dollar cost averaging. It is a commitment to a process. Conversely, averaging down goes to the thing that Devlin said. If you like it at 65, you'll love it at 23. Well, if I believe in this portfolio that I'm buying, and for whatever reason, it drops in value half, oh, I need to put some more money in. So I had basically a double dipping effect through the first quarter. I was dollar cost averaging and averaging down. I was speeding so much money into my cryptocurrency portfolio. At one point, I had $100,000 in the portfolio, which was basically $75,000 of cryptocurrency coins and $25,000 of cash. I bring that up because it's very important, because my intestinal fortitude got tested about a month ago. So in the middle part of June, as I watched my cryptocurrency purchases, and I'll just stick with Bitcoin, start at 46,000 a Bitcoin and go all the way down to 19,000 in early June, I said to myself, damn. I literally said, damn. That was the word I used. And I said, you know what? I still believe in it. I still love it. I still want everything that I thought in January. I still believe now. However, I have yet another opportunity to use my financial noggin in a way other people may not use theirs. I'm going to harvest my losses. And on June 14th, I sold every cryptocurrency coin I had. I realized the losses that were built into my portfolio. And then I started again, dollar cost averaging back into them. But because I wanted to get back into them quicker, I changed my $1,000 investment to daily. So literally every day since June 14th, I've been putting $750 into Bitcoin, $125 into Ethereum, and $125 into Chainlink. These are the three coins that I am particularly DCAing into. At that point in time, I believe my portfolio was down to $61,000, of which $25,000 was still cash. So when I, over the next 36 days, put all the money back into the coins, now this is where the gut check happened. Was I really ready to take this $25,000 of cash that I had left and go in? And the answer was yes. So now today I have 11,000 in cash. So I went 14 more days of cash. My portfolio since that time is back up to 79,000. It's off the bottom of 62 up to 79. And it's rising steadily. And this last week we've had some give back. My point of giving you my whole personal story is I didn't panic and change course. The plan is still the plan. Now, because I know a lot more than the average investor, I put another twist on it with the tax loss harvesting. But now I have a portfolio that on paper is down 20%, but I got tax losses that say I'm down 40%. So at the end of the year, I can offset those taxable losses against other parts of my portfolio. I give you guys the backdrop, and I know I'm not the guest, you are, but I wanted to give you guys a lead up into asking you, what are you telling people who in January thought that cryptocurrency was the next best thing to the golden egg, and now they've been hit with worry, they've been hit with tumultuous markets, they've been hit with turmoil and fear? How do you manage that for people who you're talking to?
I guess I'll
go ahead, Chad.
I'll hop on that first. So I pretty much like you said, Tank, right? I am a big proponent of dollar cost averaging. Just because, you know, it is really hard to time the market, whatever, not just crypto, that's the stock market or anything like that. And so my management plan that I tell people is to continue dollar cost averaging. But then I also tell people that, like, taking a 30,000 foot level, like zooming out of the market, is like really understanding and taking this opportunity to learn how to manage your money, right? What Tank just described, how he was able to manage his situation, you know, that's analogous to the real estate market, it's analogous to the stock market. You know, Amazon had a point where it was really down in the dumps, right? And now when we think of Amazon, you think of one of the top companies in the world. But it really does come down. There was people who were in Amazon at a certain point, didn't know how to manage it, and kind of lost out on those gains. And so really, that's the main thing I'm telling people: dollar cost averaging, and really figuring out what is your management style, right? If you are a person, I'm a person who I don't mind looking at my portfolio down, right? So, whether it's the stock market, crypto market, as things are going down, I check myself every day and I look at it, right? I look at it as like looking in the mirror. There's other people who they hear it's down, they can't look at it. If you're one of those people and you want to stay in the market and benefit from it, I'm not going to tell you to, keep checking in on it, but set your dollar cost average into automation, making sure it's an amount that, you won't miss, almost like another bill, like a cell phone bill or anything like that. And then just be patient, right? There is, like I said earlier, a lot of uncertainty in all markets right now. And timing the bottom or trying to time the bottom is something that we all naturally want to do. But even if it's 5%, 10% off the bottom, and you get in at a point where you feel more comfortable that if it goes down a little bit more, you won't panic, can set yourself up to be in a better position 1 year, 2 year, 4 year, 5 year, 10 years from now.
Devlin?
I'm gonna echo your sentiment on the tax loss harvesting. So my crypto investment journey is about 3 years old now. I should have been, right? I was adjacent to the market. I knew about it, but I never dipped my toe in. And I really started as an investor in crypto 3 years ago. So the first year was Wild West. Made a lot of money, but paid a lot of taxes. I was quick trading. I wasn't trying to, nobody thought it was going to last, or at least I didn't think it was going to last. So I was taking profits off the table. I wasn't looking at long-term capital gains, trying to hold things for a year. Wasn't my focus at all. I was 3, 4, 5, 6 times up on my initial investment. And I'm thinking I got house money. I just got to take it off the table. I'll pay whatever the taxes are. I made more than the taxes. So after that experience, year 2, I went totally pendulum swing the other way, which is I'm going to buy stuff and not touch it. I'm going to hold everything for a year. I'm not going to pay it. I'm going to wait till long-term capital gains. And of course, that meant I held, in hindsight, somewhat foolishly, as numbers came down precipitously from the peaks through January, February, March. And then I found myself in a similar situation at Tank, where I had a lot of harvestable tax losses. So by taking those, I'm now kind of back in the game to a certain extent. I was kind of on the sidelines, just watching and minding the store a little bit, but essentially waiting for the clock to run out. I'm now back in the game. My number's been called. So what that's let me do is start to take advantage of stop losses in my short-term trading, which I didn't before. And even now in my retirement platform, I use a company called iTrust Capital. They now allow for stop losses within the retirement, the self-directed IRA investments. So because of the volatility, I'm now able to play that 5% up, 5% down game. Generally speaking, not financial advice, but what I tend to see is that when we take more than a 5% loss, that quickly becomes a 10%, a 15%. When we take a 5% gain, that quickly becomes a 10 or a 15. So I've been playing in that 5% plus minus with buys and sells and having fun doing it. Market's trading a little bit sideways. So it's almost, funny, Tank, my conversations always come back to playing cards. But if you ever sat around a poker table, a lot of times it's about not getting into bad hands. It's about only playing when you've got the right hand. So as we saw a couple of times over the last 60 days or so, there were moments when, hold on one second, I'm sorry. There were moments when everything seemed right to make a play. And those thankfully panned out a couple of times in a row, and you're able to get these 20% swings on a pretty much sideways market. So that's been the advantage for me. Once things reset and we're back to, no more taxable, no more tax loss harvesting to have, I don't know, it gets boring again when you're sitting waiting for the clock to run out.
So let me touch on one concept that Devlin highlighted: stop loss. This is an educational program, so I always want to talk about what terms you may hear and what they mean. Stop loss is very evident for people who are in the industry. It stops a loss. So you have the ability when you invest, and all of the abilities that you have with stocks, bonds, mutual funds, and ETFs are now established in cryptocurrencies as well. So you can own a cryptocurrency, and let's just use Bitcoin as an example. I'm not sure what Bitcoin is today. I want to say it's somewhere around 23 or 24,000. So let's just say it's $24,000. If you own Bitcoin and you feel as though Bitcoin's going to go up, but you're a nervous Nelly and you don't want to lose any more money than 20% in Bitcoin, 20% of 24,000 is $4,800. So you may say, I'm going to put a stop loss order in at $20,000. 24 minus 4,800 is 19,200. You don't want to get there. So if it crosses under 20,000, it's going to sell all of your Bitcoin. You are guaranteed to never lose more than $4,000 downside. That is called a stop loss. It stops your losses. And you can do that when you want to make sure you're limiting the volatility. Because as Devlin said, the one thing about cryptocurrency, I see it in all markets now, but of course I see it more in cryptocurrency. The losses are wild, and the upside is wild too. You see 3 and 4% gains and losses like this in markets nowadays, and especially in cryptocurrency. It's really not for the faint of heart. And the reality is, and I have a whole audience, a whole nation of WOW members here who know that I say this to you guys. You've heard it a million times. I bought my cryptocurrency for retirement. It's a 10 to 12 year play for me. The fact that I'm paying this much attention to it over 6 months is more than I want to do. I would love to set it and forget it. But the volatility has given me so many other opportunities to tax loss harvest, to average down, to do things that have brought more attention to it. But the reality is this 6 month period, or now we're in August, so 7 month period is a drop in the bucket to the 144 month period that I am owning cryptocurrency for. So we always have to be forward thinking and realize what is our end goal here and how much is this short-term blip affecting us. So when we're looking at cryptocurrency as a space, and I'm going to direct this question back to my astute colleagues here on the program with me. Are you more so there's been a lot of criticism on cryptocurrency that people originally held it out to be a hedge against inflation and to also be more of a non-correlated asset to the general market. So I'm going to explain both of those terms before I ask my question. Correlation for the audience means how closely related the action of one asset class mirrors another asset class. So point in question is we normally compare everything to the S&P 500, the general market. And we're always looking for something that is not closely correlated to the market. Because for most people, that is going to be where the bulk of their investments are, is in the stock market in some way, shape, or form. So if the stock market goes down, you want to have a portion of your assets that won't go down, that are hedged against it, and may even go up. You want something that's opposite correlation. So people originally said that cryptocurrency had an inverse correlation to the market. I don't know where they came up with that and why they concluded that, but that was the popular logic that was out. The other thing, because it is decentralized, because it is not controlled by a central government, people felt as though cryptocurrency is a hedge against inflation. When prices are naturally going up in America or beyond, it should have no effect on cryptocurrency and it should go the other direction or at least stay neutral. We have seen in the beginning part of 2022, neither of those statements are true. Does that make cryptocurrency the devil and bad? No. It makes the people who made these assumptions about cryptocurrency look foolish because all they could do was guess. The information, there wasn't enough track record to tell us what was going to happen. Now we see the correlation is, we see a lot of correlation between cryptocurrency and the NASDAQ because the NASDAQ is so tech driven and cryptocurrency takes a rap as a technology sector. So I tee that up for you guys to say, What are your thoughts moving forward on the asset class, where it fits into someone's portfolio, whether you think it's closely correlated to the markets, not closely correlated, or it's too soon to tell? Devlin, what are your thoughts?
So I have to unpack the asset class. So I don't think they're all in one basket. I think you have Bitcoin in category asset class A, and you have everything else in asset class B. And I'll let Chad speak to asset class A because that's his thing. And I am definitely a class B guy, right? So I'll speak to you about Ethereum and Chainlink and Matic and technologies. And I'm choosing to use that word specifically that enable business processes to run more efficiently with higher trust, low cost, all the wonderful things that distributed ledgers and smart contracts do. Those should appropriately trade as a 5x multiplier of NASDAQ tech stocks. They are tech-enabled features and functions for businesses. I think that's appropriate that they're treated that way. When it gets to hedging on inflation and Bitcoin, I'm going to give that stage to Chad, but I do not think that what we're seeing now is the appropriate treatment of Bitcoin. I do not think we're at a maturity place yet where Bitcoin is truly holding its hedge as it should. I think we will a few years down the line.
I love it.
Yeah, I think kind of what Devlin said hit the nail right on the head. I kind of look at it this way. Again, same way Devlin does. I do separate Bitcoin from other cryptocurrencies, but I look at it more as the market goes through its market cycles, but I think this is more of a risk on versus risk off scenario in the sense of this bull run that we kind of just came off of. A lot of it was due to free money being put out there, whether stimulus, the Fed pumping money into the system where people could be risk on, basically exploring, putting more money into asset classes that they're interested in. When basically the Fed tightened everything, people then basically money becomes more expensive and people have to assess and be more picky about what they're putting their money into. And as Devlin spoke to, I just think the asset class, crypto asset class as a whole isn't mature enough yet where people, when they go risk off, they're looking at Bitcoin or they're looking at crypto as an option, right? As it hasn't been adopted enough, even though you hear it in conversations, you might see it on your social media. On the grand scheme, it hasn't been adopted enough for people when it comes down to, hey, where am I putting my money, especially in an inflationary environment where everything's getting more expensive. People are thinking of, hey, I need to buy food, or I need to put it into the S&P 500 because it has that long track record of, even though it's going down some, it's going to hopefully eventually recover and bounce. So I just think it's more of an issue with that once people became risk off, cryptocurrency, that general market is not a place yet that's mature enough that people look to store their money as a safe haven, even though if you do have, I'm completely biased. If you do have an understanding of Bitcoin specifically, you can consider it a savings technology.
I love it. And I'm going to address the length issue, the track record time. I have a great comparison. I've used this comparison before in the insurance market with long-term care insurance and its early years treatment versus its current year treatment. But before I get into that comparison, Sister Lindsay poses a interesting question / scenario. She says, I stopped my weekly dollar cost average into Bitcoin and moved that money to weekly I bonds. And I'm going to continue doing that until this 9+% rate expires in October. I'll probably switch back over to Bitcoin, Ethereum after October. What are your thoughts? So I'm going to let you guys jump on that, and then I'll bring up the rear with my thoughts. Go ahead, Devlin.
So I looked at the same thing. I opted not to go with I bonds. But yeah, definitely a great time. From what I understand, there's some tail to that. You give back a certain percentage, and yet there's a certain required hold period. not an expert, but I did look into it myself. Where I ended is that between the NASDAQ and how low cryptos were, I'm getting 9% on certain days. So I'm being more strategic about when I place those investments. I'm being more cautious, like I said before, covering those investments with stop losses. When I first started to come back in, I was playing with super tight margins. Like if it goes down $5, I'm out. Like, I'm just trying to like dip my toe in the water and catch it. I know that's not a great strategy, but when we're bottom feeding, there are days where you can catch that kind of wave. You just have to be really on top of it. If you don't have the time for that, then I don't advise. Like that's a full-time commitment.
Brother Chad.
Yeah, for me, I'm a proponent of when you dollar cost average, getting in the habit of always doing it. Even if you switch the amount, say every week you're putting in $25, if you want to allocate towards the I bond, maybe you take that to $10, because I do think it's one of those things where it's more important to build the habit and commit to it, right? If you do believe in Bitcoin or whatever you're actually dollar cost averaging into, I'm big on the commitment side, only because there will always be other opportunities to make money, right? Whether it's stock market, investing in a friend, investing in yourself, millions of opportunities out there every single day. And if you are a person who's looking for, almost yield farming, for lack of a better term, then yeah, like picking and choosing your spots, I have no problem with it. But strictly for dollar cost averaging purposes, I always say, if you're going to do it, stick with it for at least 4 years. And if you have to lower the amount, but every week or every 2 weeks, whatever your schedule is, commit to that and stick with that. And that's a contract with yourself that you have to stick to, as Kobe Bryant said.
I love that advice. So here's my take on it as well. A long time ago, and I'll put him on blast, my best friend was my first brokerage client. And he and I had a huge debate about paying for his house he was building, paying for it in cash, which is what he wanted to do, versus putting the money in the stock market and letting the growth of the stock market outpace the cost of the mortgage he would have had, which is what I wanted him to do. Ultimately, he went with what he wanted to do. And as he will tell everybody, he tore every ligament in his leg like 4 weeks after making this decision. And he swore that, he made the right decision, that it was backed up to make sure that he didn't leverage himself at a time where his career was short to be after that. I still told him he was wrong, though. And I still stand by my opinion. But here's the thing. We were both wrong and we were both right. The reality is very seldom, and people hate this level of uncertainty, and I wish I could give you more certainty. But what's right is what makes sense for you, what makes you sleep at night. You can be proven numerically correct later, but if you were nauseous the entire time that happened, it wasn't right for you. So when I see Lindsay's proposition of going to the iBond as opposed to the cryptocurrency space, I have to say, I'm comfortable in knowing what I know about Lindsay and her time here in Wild Nation, that she's pretty comfortable with a 9% return from the federal government, and that makes her sleep well at night. So I dollar cost average. I've already told you guys what I DCA. 70% into Bitcoin, 12.5 into Ethereum, 12.5 into Chainlink. Well, guess what? Since June 14th, Ethereum's up like 88%. Had I dollar cost average 70% into Ethereum and 25% into Bitcoin, I'd be back over my 100,000. But do I kick myself every day that I didn't do that? No, that's not my plan. My plan is my plan. And yeah, I just take the grace that 80%, 12.5% of my portfolio is up 80%. I'm happy with that because all three sectors are up. Chainlink is up, Bitcoin is up, Ethereum's up way, way more than the other two. I know Devlin is a happy guy. He's an Ethereum guy. But for me, Bitcoin is my flagship. That's my core guy. And then I'm Ethereum, then I'm Chainlink. And I even got a little dark horse that I don't mention on the program because I don't want anybody else going out and buying it and saying, oh my God, it didn't do what Tank said. But I got another coin in there, and my guys who are smiling, they know what it is, but y'all got to guess. So when you choose a strategy, I think both the guests are correct. I know they're both correct. You have to stick with the strategy. The thing about dollar cost averaging, and I didn't say it when I gave the definition, but here's the key part. And I think it's the most important part. Your dollar cost averaging an amount that you earmarked you could afford to put into the investment in the first place. So let's say it was $5,000 and you determined that over a 3-year period, you were going to dollar cost average $5,000 into a bucket of investments. You got to think anywhere along the way, you haven't gotten the $5,000 in yet. So the dollar cost average program needs to continue because the goal was to put the 5,000 in. Have you let something occur? Have you let something that has occurred influence your decision so much that you're going back to your original plan and saying, you know what? Something has changed so dramatically in the landscape that I'm not doing $5,000 anymore. And if you can sit there comfortably with yourself and conclude that that's what should happen, change the plan. I like Chad's thought on reducing the plan, spreading out the amount of time that the 5,000 needs to go in. So now you can go $10 a week instead of $30 a week. But the plan should always be malleable enough to change when needed, but firm enough that you're not whimsical. That's my belief on a dollar cost averaging plan. I want to, that's a great question, Lindsay. Thank you very much. And I know you're winning with that strategy, so I do like that for you as well. The 9%, the I bonds are amazing, and I've told many people on the show, get them for yourself, get them for your kids. You got to get these I bonds while they're giving this money away. We're switching gears a little bit, and I just kind of touched on it with the whole comment about Ethereum. So we have, and I'm not going to pretend to sound like I know what I'm talking about. I'm going to quickly hand this to Devlin. But you have this event surrounding Ethereum's evolution and changing to the 2.0, 3.0, whatever you'll talk more intelligently about it. I spoke to another Wild Nation member who's also a very good friend of mine. Shout out to my man Brian Brew Revel. He knows I've known him for 20 some years, and I always feel very uncomfortable with how I pronounce his last name. And he tells me all the time that I'm effing it up. But the reality is that we were talking about things that are priced into the market. So when you see an 80% uptick in the last month in Ethereum, this precedes the new evolution of what's going to happen with Ethereum. So when that happens, are we to say to ourselves, it's already priced into the stock or priced into the coin? What are your thoughts there, Devlin?
Well, I love the 80% up if I wasn't still looking at 4,000 and thinking that was the right price. So, so that's all. Everything in crypto is still finding its price. So you really can't hook yourselves to old numbers and say that's where it belongs. That's a trick you have to try to talk yourself out of. So Ethereum 2.0, the migration from proof of work to proof of stake. I'll explain what that means quickly. So right now, the way that transactions on the chain are verified is through proof of work, through mining. Mining has sort of a bad rap because of the energy utilization that goes into that process. And we saw a lot of backlash last year with Tesla and others where society kind of pushed back and said, yeah, that's great, but look at all the energy you're spending to do that process. So that's the proof, what's called proof of work, where you have to prove it to churn horsepower, CPU power, to solve a puzzle, for lack of a better term, to prove an entry on the block. Proof of stake is a different model. Proof of stake means that you have enough interest, monetary interest, in that being true, that you are a validator, that you're putting your money where your mouth is to a certain extent, which is very similar to contracts, the way that we work in society today. There's punitive damage if you are wrong. If you break the terms of the contract, there are financial repercussions. So the good thing about proof of stake is that it does not come with all of the carbon footprint and optical and real sensitivities that come with that. So it should allow for large companies to adopt the technology without having the stigma of carbon offsets and harm to the planet. That's the upside. The downside, as we're seeing in some cases already, is that the size of your wallet now is directly proportionate to your influence on the currency. Something like Ethereum, thankfully, is fairly widespread. But in these smaller coins, you're seeing where one or two holders can really influence how things are happening. And that's not kind of in the spirit of the meritocracy of these assets. This distributed ledger and DAO concept is meant to be that everybody has, a say in this. So there's things on both sides. Now, the one key piece of this to keep in mind is that there's this idea of staking. And I don't know how much you've talked about that, but staking is where you've committed your asset for a certain period of time for a fixed return. So on top of the gain that you might get where the asset value goes up and down, you're also getting a fixed return like you would in a more traditional CD. Not the same guarantees or anything like that, but a fixed return based on the value of your asset. So a lot of money, I don't know the number, but certainly hundreds of millions or billions of dollars is already staked, already locked in as part of this Ethereum upgrade. People the Ethereum community incentivized that process so that the validation can occur to get ready to go to 2.0. Sometime after 2.0, that staked money will be unlocked. And the big question in the room is what happens then? What happens when a lot of people, myself included, who have been unable to sell an asset for an extended period of time, a year plus at this point with the delays keeping, will the market get flooded? Will a certain percentage of those people liquidate, which will cause the value to drop quickly? Or is it the inverse, which is that once we finally get over the hump and 2.0 and proof of stake is released, the adoption process picks up and we see adoption from large entities? That's your scale on that one.
What do you think is causing the recent uptick in Ethereum?
I think it went too low. I think that it's all of this 2.0 stuff is old news. It's been getting delayed, and we're hopeful that this time it's really going to stick. And I think there's general positivity around that. But I think that when it was down sub 1,000, like that was just incredibly low, and and unnaturally low. And I think that the price we're at right now is an accurate price. I feel as though this is an accurate price where we are, and I still expect upside after we do finally get over the 2.0. I do expect us to go down when that unlock happens, but we don't know when that's going to be yet.
Chad, what are your thoughts long term for reestablishing previous highs for Bitcoin?
My gut tells me 2025.
Okay.
Bitcoin, for those who are familiar or aren't familiar, works on pretty much like a 4-year cycle where there's this event called the halvening or halving, where basically the amount or the supply of Bitcoin put onto the market gets cut in half. And so this usually basically causes a supply shock. And what we've seen is that 18 months, whenever the halving happens, 18 months after, Bitcoin goes up parabolic, and then it crashes down 80%, elevator up, stairway down, or stairway up, elevator down, excuse me. And so my conservative estimate would say 2025. Again, as what I alluded to earlier, I do think a lot of the crypto market is really depending on what happens to the macro market. Again, if there's a situation where the Fed can't curb inflation, or they're forced to start more quantitative easing based off of just everything that's happening in the world, I do think that it could be a catalyst to push all markets up. But my conservative, what I would tell my brother or my mother would be the expectation is 2025. But the optimist in me believes it'll be earlier, but I feel comfortable saying 2025.
We have about 10 minutes left in the program, and I'm going to do something that I haven't done when I've had you guys on before, which is to make your own counter argument to yourself. So we're going to start with Chad telling me why you should invest in Bitcoin today, and then telling me why you should not invest in Bitcoin today. And then I'm going to have Devlin tell me why we should invest in Ethereum today and why we should not. So Chad, take it away.
The reason I say you shouldn't is two reasons. One, I think to responsibly hold Bitcoin, it takes a lot of personal responsibility that I think a lot of us aren't accustomed to. A lot of us are accustomed to, relying on a bank of sorts to not manage your money, but hold your money, and all of the services that we have today, where the credit card, debit cards that are linked to our bank, are already built in place and are ingrained in us. And so there is a huge learning curve to not even just Bitcoin, just being involved with cryptocurrency. So outside of the personal responsibility, the other thing I would say is there are a lot of dominoes that have to fall in Bitcoin or crypto's direction for it to be adopted on the global scale, right? Now, I personally believe all those dominoes don't have to fall for Bitcoin and even Ethereum to be used throughout the world. But, you have regulation, one of those things to consider all the time. You have the education barrier, right? Like a lot of people don't understand traditional finance, right? So, and to understand this non-traditional finance, you still need to have almost an understanding of traditional finance anyway. So this is a big learning curve. That is a barrier to entry. And then I guess the last reason I think that Bitcoin possibly won't be adopted is that maybe quantum computing. I think that's the big kind of cloud in the corner of the room sometimes, that people think that once we really use quantum computing at scale, something like Bitcoin could be vulnerable. And I do think if Bitcoin was ever to be hacked, not a wallet, but Bitcoin directly, I think that would be terrible. One of the worst things that could happen for the overall market. It's something that I'm not too worried about personally right now, because I think I know how to navigate that quicker than most people, if that were the case. But it is something that, even though I'm 99.9% on the side of, this will be an asset class here to stay, that is that 0.1% that always have to consider and always have to be proactive, keeping an eye out for the technological advances in that field. So,
love it. Dev, make your own counter argument.
So my pro and con argument both revolve around the same word, which is trust. So on the pro side, I see distributed ledgers, smart contracts, decentralized finance as the monetization of and the technology around eliminating trust. So when I enter a transaction today with fiat currency, a lot of money is spent in contracts to enforce trust. There are things that I will not do with my money because I don't trust that it will be done how I expect. Basic concepts like charitable giving. People have a fear that not to give. People do give, but they have a fear that their dollar isn't going where it could be best used, or how it's being used, or who's being paid in that process. There is risk in financial markets and transactions, making sure that all the money gets where it belongs at the right price. There's risk in investments. Is my broker making the right amount of money? Do I have to check on them? Every industry, it's pervasive. There is a lot of time and a lot of loss around trust. The technology, when exercised correctly, eliminates the need for trust from the transaction. Everything is what it is. It will always be what it is. It can't be anything but what it is. So trying to put a value on that is impossible. This is truly a technological revolution like we've never seen before. It is and will be more important than the internet. The internet was the monetization of information. Digital currencies are the monetization of trust. And that is why I have confidence in the technology. The counterpoint is also trust. If at any point that trust is breached, so Chad's examples, if there is a widespread hack, if there is a loophole in the code that can be exploited, if there is quantum computing that can crack encryption, if there is enough of what we've been seeing lately about different platforms and exchanges shutting down in the middle of the night and people losing their money, if there's too much of that people no longer trust the solution, then it truly is tulip mania. It is a Ponzi scheme. It is all those things it's made out to be in certain conversations if the trust is not there. So
I love that answer. The reality is that we have a whole economic system built on trust. When we saw the run on money in 2008, it was the first time a money market had ever dipped below its net asset value of $1. And all of a sudden, people were concerned they were going to go to ATMs and put the money code in, and the money wasn't going to come out. And once you lose that trust, it's precipitous. It goes so quickly. It's wildfire. And that was something as venerable as a 2-century-old economic system. When you think of something as tenuous as new money, as a new money system, as cryptocurrency is, I think it's going to take a lot less to shake the trust here. So, yeah, I'll stay tuned there. You make a very valid point. Both of you gentlemen do. With that being said, it's funny. As we get to the end of the show, I'm going to kind of take it back to my private equity investment that's going on in the very short order. And I'm investing alongside my clients. And the amount of money that I need to put into this investment is calling upon me to have to liquidate a large portion of my cryptocurrency holding. And I just can't bring myself to do it right now. Like, I'm stalling because, when you believe what you buy, as the old saying goes, you buy very, very, very slowly and you sell never. Like, people aren't really investors like I'm an investor. People are traders. They're whimsical. They're nervous. I buy for the long haul. And the thought of selling, especially when I'm down, even though the opportunity cost is so great, like the opportunity that is in front of me says, you got to do this, Tank. But it's the true testament to who I am as an investor, because I don't want to let go of the reins of the ship that I have guided out of the port onto the open waters, and I see the destination ahead of me. But, right now, and I'll use this as a 15 minutes of finance topic next week, maybe, I was able to use some of the cash value in life insurance policies I have very quickly, too. I uploaded the request for money on Sunday night, and it hit my account today. Like, that's just crazy how quickly it turned over. But I was able to put about 35 to 40% of the money that I need from the investment, pull it from the cash value of my policies. So I'm a little happy that I don't have to liquidate all of the cryptocurrency, but stay tuned for the update on that, because that's a more 24-month to 36-month time horizon on an investment that could change me and my family's lives moving forward. So I will make that change. I want to thank you guys, from the bottom of my heart, for coming on, for sharing this conversation with the audience. I want to thank the audience members for being here. I know it was a technical show, but a show that needed to be said nonetheless. I thank you, Sister Lindsay, for your question. I thank you, Sister Tashawana, for helping us in the chat with the various updates from Investopedia. I love you guys. And I look forward to seeing you guys in 2 weeks for the next Financial Power Hour, and look forward to seeing you guys tomorrow on 15 Minutes of Finance. It's a wrap.